Okay, good afternoon, everybody, and thank you for joining us today. My name is James McManus, and I'm the Head of Investments at Nutmeg. And I'm joined today by Claire Exley, who is Nutmeg's Head of Financial Advice and Guidance. Now, with everything that's been happening in financial markets over the past few weeks, we know it can be an unsettling time to be an investor. So we've set up this webinar so that you, our clients, have an opportunity to hear from us directly, but also to ask us your questions. And based on what we've seen from the questions you've submitted to us while registering, we know that you've been following the news and are well aware that the tariffs announced by the US Republican administration have been at the center of this period of heightened market volatility. And we also know that many of you want to understand more about the movements in your portfolios in recent weeks and what to expect going forward.
Thanks, James. Another topic that's been touched on by some clients is that although they are long-term investors, they have some pressing financial goals that have been disrupted by the tariff-induced market volatility, whether that's an upcoming house purchase or adjusting finances from retirement. If you have a more immediate financial goal you're trying to navigate, our financial advice and guidance team is here to help. There'll be QR codes on screen throughout this presentation to scan, which will enable you to book a free call with our team to discuss your individual circumstances. Because each person's situation will be different, it's hard to provide an answer today that will be right for everyone. So we do encourage you to get in touch. And before we start, I want to remind everyone that whilst we'll start the Q&A with some questions that we've already received, we'll also be taking questions live today. So please add your questions by clicking the Q&A feature at the bottom of the screen as we go along. We'll get through as many as we can, and at times we might group questions that fall into similar themes. If we don't get to your specific question, or if you would like further support, then please do get in touch with us. On this note, I do want to point out that this presentation is provided solely for information purposes, with the goal of helping you to understand the current context and then feel empowered to make the right decisions for you. What we'll share today doesn't constitute advice or a recommendation to make any investment decisions. The information's not tailored to the needs of any individuals and should be used as an aid to your decision making rather than a guide to investing. If you do require tailored financial advice, you can book a free call with the team as a first step. At Nutmeg, we provide restricted advice, which means we will only make investment recommendations on the products and services that we offer. And as with all investing, your capital's at risk. So that means the value of your portfolio can go down as well as up, and you may get back less than you invest. Past performance and forecasts are not reliable indicators of future performance. In terms of the structure of the webinar today, James will briefly run us through what we know in this current period of uncertainty, including what we've seen play out in markets in recent weeks, and what may be the more enduring investment themes throughout the year. He'll also cover the actions the investment team is taking in light of these factors. And then I'll cover off what this means for investors, including some key principles that investors might want to follow in times such as these, in meeting both your longer term and shorter term financial goals. And we'll make sure we leave a good chunk of time for Q&A. So James, over to you.
Great. Thanks, Claire. Now, Claire just referred to the current times as a period of uncertainty for financial markets. And I do want to start by emphasizing that word uncertainty as I cover off this first section. We've called it, what do we know in this current climate? But I'm going to be very transparent here and start off by saying that there is a lot that all market participants, including ourselves, do not know either. So as far as geopolitics goes, we do need to acknowledge that what we're experiencing this year isn't entirely typical. Usually markets are able to price the probability of upcoming changes of policy, which means they anticipate the potential impacts of announcements from politicians and policymakers ahead of time. And to avoid drastic swings in financial markets, governments and central banks tend to set expectations as clearly as possible to give the market time to absorb the information. Meanwhile, investors and analysts obviously pore over the underlying economic indicators that policymakers and governments are using to make those decisions in an attempt to foresee them and understand the implications. And that's a type of scenario analysis that investment teams undertake on a daily basis, recognizing what is known, but also what is unknown to map out potential scenarios. But what we've seen so far this year is a US administration that has surprised investors somewhat with its policy communications. And that is to say that the common thread of their approach often appears to be rapid, changeable decision-making that's not always in line with the expectations they've set in their prior public communications. And it's also not sometimes clear what data points are informing those decisions. I think the tariff announcements on the so-called Liberation Day were an important example of this. To illustrate the point, we've borrowed a chart here from our colleagues at JP Morgan Asset Management because it does a really good job of showing the situation that we're dealing with. So this chart shows the US effective tariff rate dating back almost 100 years, and that is in essence the average rate of tariffs imposed on imported goods into the United States across all trading partners. On the far left, sitting at almost 20%, was in the mid-1930s after the Smoot-Hawley Tariff Act. That was actually brought in with the intent of helping American industry and American farming recover from the Great Depression by encouraging domestic consumption. But what we see on the right-hand side, though, is the large gap between expectations the US administration set about tariffs in their announcement at the end of March in purple, what they promised as part of their campaign, which of course included a 20% universal tariff, excluding free trade agreements, and a 60% tariff on China. What came in terms of tariffs on the 2nd of April, and then of course the latest proposal as at the 25th of April. But put frankly, no one expected the tariffs to be this high, even near term, and this is what has caused markets to be especially unsettled in the aftermath. So in terms of how this has played out in markets, well, we won't spend a huge amount of time on this point as it's been all over the news. But what we do want to highlight here, though, is that this initial shock was very much linked to that Liberation Day announcement. But the picture has actually already improved somewhat in global equity markets since. That said, we think we can expect the short-term picture to be one where markets move up and down for a while yet. Financial markets don't like uncertainty, and they're not going to find certainty quickly in the current environment. And despite that 90-day pause on many of the most severe tariff rates on the 9th of April, trade barriers have still been significantly increased since the turn of the year, particularly in China, where escalation has resulted in that punitive 145% effective tariff rate. So we expect tariff headlines to ebb and flow over the coming months as countries negotiate and the US administration updates its approach, and we expect equity markets to continue to react to that news flow. But whenever markets are volatile in the short term, it's always worth zooming out on a longer term horizon to retain perspective. On the right-hand side of the slide here, you can see that wider picture. And as you can see, over the long term, global and US equity markets have delivered strong returns for investors, despite the many crises of the past 25 years, from wars to global pandemics, tech bubbles to financial crashes. That doesn't mean that in the short term, or in fact, that the long-term returns will always be positive. And I should note here that past performance, of course, is not a reliable indicator of future performance. But it is worth remembering that, the S&P 500 US stock index hit an all-time high just as recently as mid-February. Now, much less attention in the media, but bond markets have also been impacted by the current climate of uncertainty. Some of Nutmeg's low-risk investors may also have been feeling the effects of tariffs more than they expected. Bond markets in early April did not always move in line with conventional wisdom. Now, typically an asset class such as US Treasury bonds acts as a safe haven where investors flock amid times of economic uncertainty. And that can generally see the prices of lower risk bonds like these rise when equity prices are falling. But in recent weeks, against the volatile equity market environment, we've also seen bond yields and prices move around sharply, seemingly caught between two dynamics. On one side, investors worried about economic growth, and so seeking the safe haven attributes of government bonds with a view that maybe central banks need to reduce interest rates. And on the other side, investors worried about inflation as a result of the tariffs and the associated weakness in the US dollar, fearing the central bank may need to keep interest rates higher in a weaker growth environment to combat inflation. Now, of course, the outlook for both the economic impact and the inflation impact has also been shifting with the policy announcements. And you can see that volatility in April in the bond market on the left-hand chart. But it's not just tariff policy that can move bond and equity markets. Over the past few weeks, we've also seen policymakers all over the globe considering not just their response in terms of reciprocal tariffs, but also potential stimulus for their economies, something that in past periods of market uncertainty has tended to play a key role in supporting economies. So the prospect of monetary and fiscal stimulus here should not be underestimated. So is this level of volatility out of the ordinary? Well, you've heard me say this before, but volatility is a normal part of investing, and in fact, actually a sign of a functioning financial market. The chart on the left-hand side here reflects a measure of market volatility called the VIX index. And as you can see, the level of volatility in financial markets is currently higher than the norm, but it's not inconsistent with past periods. And what we also see here is that volatility tends to spike higher and then recede, reflecting that shock effect of new information on financial markets. Now, one of the most fundamental principles of investing is to get comfortable with volatility and even to realize that volatility can present opportunities for investors. Volatile periods where there are corrections in the prices of asset classes, are an opportunity that our investment team looks for when we're managing our client portfolios. The chart on the right-hand side is helpful in demonstrating why we've seen such a spike in market volatility of late. One measure of US policy uncertainty is at an all-time high, even exceeding the COVID period. Now, policy uncertainty over the past months has certainly not been helpful, but as we saw on the 9th of April, tariff policy can be changed quickly. It is by no means structural in that sense. It is a self-imposed regime that can be removed just as quickly as it was added, should the US administration so wish. I think this is a really interesting contrast to past economic crises in recent history, where market falls have typically been caused by more underlying structural issues, either within the household or the business sector, whereby households or businesses have become overextended. We saw that with the burst of the dot-com bubble in the early 2000s and also in the US housing market, or with the US housing market, I should say, during the global financial crisis of 2007, 2008. So a real positive of the current environment is that we don't believe economic excesses are the cause of the underlying concern. Okay, so with all the policy uncertainty, where do we currently stand? Well, clearly trade barriers such as tariffs represent a shock to economic activity, both within and outside the United States. We believe tariffs will stay to some degree. The US administration has made this a core policy anchor. And as such, we expect US economic growth to be lower and inflation to be higher than our previous expectations, all things considered. But against all the negative headlines, we also think there are some reasons for quiet optimism. Really importantly, the US economy was in robust health going into 2025. Economic growth had held up, inflation had returned to lower levels, albeit slightly above target. The labor market, or the jobs market in the United States, was still robust, again, despite some signs of unemployment rising a little bit. Household wealth and health was okay. Wages were growing in real terms. Consumption had remained strong. And the US had retained its leading position in financial markets, offering an almost unmatched dynamism, depth of innovation, and entrepreneurialism. Now, there is no doubt that tariff announcements are a headwind for economic growth and also for consumer and business confidence. But our current expectation is not for a US recession in 2025. As noted, we think the US economy was in decent shape coming into this period, but there are also some other dynamics at play it's worth talking about. Firstly, of course, we expect some softening of the impact of tariffs through agreements with individual trading partners over the coming months. Secondly, as the chart on the right-hand side shows here, the US is a major trading partner for a lot of other nations, but it relies on import and export growth far less for its own economic growth than many other developed markets do. So only around 20% of US GDP comes through trade, and that's compared with over 50% for Germany, for example. And that means the US economy is actually less reliant on trade for growth, though, of course, it's still exposed to all of those higher prices that tariffs impose. Now, in terms of global growth, the impact of US tariffs is, of course, not going to be felt equally. Global trade and supply chains have become very complex. Trading partners each have a different level of dependency on US imports, and they've also employed different strategies in regard to reciprocal tariffs, and may also have varying degrees of success in negotiating better deals for themselves. But all things considered, we think the outlook for global trade and for global economic growth is again lower than where it was at the start of the year. But we don't think the inflationary impact likely to be seen in the US economy holds true across the rest of the globe. In fact, we believe we might even see disinflationary forces in other developed market economies as slower growth and potentially lower goods prices where US demand falls and leads to lower inflation. So the next section covers the actions that Nutmeg is taking and what we're constantly evaluating when we manage your investment portfolios. In the near term, we're focused absolutely on managing portfolio risks around the less certain policy direction. So our investment team has been keeping abreast of developments as they arise, assessing the implications for portfolios, mapping out scenarios and assessing the impact on both economies, industrial sectors and companies. Being part of JP Morgan also brings the great benefit of being able to talk to other economists, investment strategists, portfolio managers across the firm to get their insights on specific topics and the wider environment. And as we expect the tariff regime to evolve over the coming weeks and months, we continue to monitor our portfolio performance and risk on a daily basis. That analysis feeds directly into our investment decision-making, and we stress test our portfolios against past periods of market volatility and measure our risk across both short, medium, and long-term frameworks. But in the run-up to the tariff announcements, Nutmeg portfolios remain globally diversified. The US equity market is a core exposure for the majority of global investors, but Nutmeg portfolios are built to offer global diversification. We offer exposure to 23 developed markets and 24 emerging stock markets, alongside investments in a broad range of bond markets, depending on which level of risk you opt for. So that diversification is core to risk management. But we've also held additional government bond exposure across all but our highest risk portfolios since late 2024, which historically, as we discussed, has offered investors greater protection when equities have been volatile. Now, post the tariff announcements, we've also continued to manage our portfolios actively. Volatile markets call for calm and rational decision-making, but we acted quickly to reduce risk given the emerging uncertainty of the policy stance. By midday on the 4th of April, our overweight equity exposure had been removed from our fully managed, our SRI and our thematic portfolios, and risk was also reduced in our smart alpha strategies, where similarly a modest overweight position in equity portfolios, equity markets was reduced. We have not, however, chosen to reduce risk entirely. And that's because the economic and market analysis should follow the policy landscape. And that policy landscape has not been certain. There are still risks both ways, in our opinion, as the significant market gains on the 9th of April post the announcement of the 90-day delay of tariffs showed.
Thanks, James. So what does this mean for our investors, and how should you, as an investor, react? Well, market volatility can be concerning for all investors, but especially for those who are close to using their funds for significant milestones like buying a home or retiring soon. And if you do have those shorter term goals and have any concerns that you'd like to discuss, then we encourage you to book a call with our team for some complimentary financial guidance so that we can try and help you make the right decision for you. For those with a longer time horizon, it's worth remembering that the value of your fund is only really relevant at the point you need to access the money. So if you have a longer term goal and nothing else has changed in your circumstances, it can often be best to not change your plans in response to short term market movements. As James mentioned earlier, typically the longer you remain invested, the more chance you have to see capital growth. Or, as this chart shows, your probability of loss decreases the longer you hold your investments. And that's because you have longer to benefit from any returns compounding and time for any periods of market turbulence to settle. So while past performance is no guarantee of future returns, history does offer us a guide that can help inform the best course of action when markets are volatile. And the first lesson from history is visualized in this chart. It's easy when markets are volatile to focus only on the negative performance days. And of course, there's an endless stream of negative commentary. But what is often missed is that volatility works two ways, which can mean greater movements in both directions rather than just losses. You'll often hear investors say focus on time in the market rather than timing the market, because volatility creates ups and downs in market prices, but it's not just avoiding the downs that investors should worry about. Since the 1st of January 2000 to the end of March 2025, the S&P 500 index has returned 285.6%. But if, as an investor, you'd missed the top 10 days for returns over that period, your return would have fallen to just 76.9%. And the next slide shows the second lesson that history offers, that falls in the stock market within any given year are actually commonplace, though this doesn't necessarily determine the outcome for that calendar year. Of course, there are always different drivers, but as the chart shows, in any year since 2000, there have been corrections in the US stock market. The orange dot denotes the largest decline in the market within any given calendar year, and the green bar shows you the performance that the stock market delivered in the full calendar year. So the average low point has been minus 16.3%, but the average full calendar year return has been plus 8.7%. In fact, in 19 of the last 25 years, the US stock market has finished in positive territory, despite having experienced losses at some point in the year. Again, another key reason why you'll hear investors say focus on time in the market rather than timing the market. So before we move on to answer some of your questions, there are a few key points that we'd like you to take away from the session today. Firstly, focus on what you can control, your actions, resisting the temptation to make changes unless you need access to your money immediately or in the very near future, or your circumstances have changed. Consider your long-term goals, not short-term market movements. And remember that volatility is part of the investment cycle, and trying to time the market can lead to missing out on upsides whilst trying to avoid the downside. So let our investment team worry about the headlines, tariff rates, global economic policy while they're managing your investments. But if you are feeling nervous about how recent financial market performance will impact your investment goals, then our team is here to talk, and there's a QR code on the slides if you'd like to book a call. So with that, we'll now turn to Q&A and attempt to address many of the questions that you, our clients, have kindly sent through. A reminder that if you'd like to ask a question live during the session, you can do so via the Q&A function. There've been a few questions asked about whether there'll be a recording available of the session, and there will be, and we'll send that out afterwards. So James, the first question we've had through is one for you probably. So, and we've had this from a couple of people, but did Nutmeg anticipate this, and what did they do ahead of time?
Yeah, so hopefully we've probably answered part of this question already. We absolutely expected the US administration to impose some tariffs on trading partners, given their communication through the election process. But I think the level of tariffs it proposed was beyond ours and, in fact, many others in terms of investors' expectations. I think, as we noted in the positioning update, in the run-up to the tariff announcements, Nutmeg portfolios remain globally diversified. We also held additional government bond exposure across all but those highest risk portfolios, which historically has offered ballast to higher risk equity portfolios when equity markets are volatile or equity markets are falling. And while we've also managed the portfolio risk actively while the news flow has changed. So we did reduce our risk in terms of our US equity exposure. We took that down to a more modest level across portfolios, and we removed our overweight equity portfolio that we'd overweight equity position, I should say, that we'd held through the beginning of the year. If we go back to the beginning of the year, our outlook for the year was relatively positive in terms of particularly the earnings journey for earnings trajectory for major US companies. Clearly, we've measured that somewhat, and we've reduced our exposure to those businesses. But we still think there is an opportunity to invest in the US equity market, and we still think it can deliver positive long-term returns for our investors.
Okay, Thanks, James. And similar question, is the investment team looking outside the US at times like this? What is the team's view on emerging markets, Europe and the UK?
Yeah, I mean, we're always looking outside of the US. As you said, our portfolios have exposure to 23 developed markets, 24 emerging stock markets. So, we invest all over the world on behalf of our investors, and we're also always looking at each of those regions as part of our monthly investment process. When it comes to Europe, UK, and emerging markets, they are regions that form part of our portfolios today. In Europe, we currently favor the industrial sector as well as some of the Nordic nations, but also we're recognizing the importance there of the fiscal stimulus that has been announced in recent months for the broader European economy, a factor that we think can help offset any tariff impacts. UK markets have been so far relatively sheltered from tariff impacts, but our view is actually fairly neutral on the macroeconomic dynamics at present in the UK economy. Businesses are still digesting the impact of budget policy, and a housing market recovery remains relatively nascent there. So although sheltered from tariffs, tough to get too excited about the UK macroeconomic picture from our perspective at the moment. And then in emerging markets, emerging markets really still do have a reliance on global trade. So that's a key watch point for us, given what's going on with the tariff story. Emerging markets are trader nations. They are more reliant on US growth and US trade for their own economic prosperity. China's economy remains somewhat weak domestically, and although stock market declines have improved valuations in China, this isn't really enough yet to offset our caution over the economy, particularly in light of what's going on with US trade tensions. I think in China, particularly technology stocks have been a bit of a bright spot. Until recently, that sector has really been out in the political wilderness because of the government policy. But those government relations now appear to be thawing, and hence why we've seen a stock price rally in that sector. But I think for now, we're letting that tariff policy play out. We want to see where the US and China land in terms of their trade relationship before we would reconsider a bigger emerging markets position.
Thanks, James.
So I can see a couple of questions on the chat that are in relation to US equity allocation as well. So why don't we? I can pick that up as well. So our portfolios do have a large allocation to US equity markets. US equity markets are the largest equity market globally by quite a significant margin, though. In fact, they represent more than 60% of global market cap, i.e., if you measure the total value of equity markets globally, about 60% or more of that is US equity markets. So we don't hold 60% in our portfolios. Even in our highest risk portfolios, we're in the 40s in terms of percentage exposure to the US. But we have historically favored the US equity market over the past couple of years, partly due to the strong performance that we've seen from some of those US mega caps, but also because of the dynamism of the US economy and also its capability to deliver earnings. We have, as I said, adjusted portfolios recently, reducing our overall equity exposure to neutral and also maintaining a more modest overweight to US equities. I think there's a couple of perspectives here. So from a long-term perspective, in our view, the US remains still a really highly flexible economy, with significant advantages at the corporate level. They include things like workforce flexibility, really robust innovation and investment capabilities. And as we moved into 2025, the US economy had really demonstrated its resilience and its sustained growth that had actually surprised a lot of investors through that post-COVID recovery period. Remember, post-COVID, over various periods, a lot of investors were calling for recession in the US economy as the Federal Reserve had to raise interest rates in light of higher inflation. The US economy actually has continued to surprise investors in aggregate with how resilient growth has been, how resilient consumers have been through that post-COVID period. And we also think that US corporate earnings growth continues to be strong relative to other regions. Now, of course, we need to measure that with expectations of what's happening with tariffs. But in recent earnings seasons, including the one that is going on right now in the first quarter of 2025, earnings growth continues to look robust. So, we believe the US on a long-term basis still holds a strong competitive advantages that can justify a premium or higher valuations compared to other markets. And it might be a little bit too early to start betting against the US long term. Now, of course, in the short term, there are nevertheless some real uncertainties that we can't ignore and that we've discussed somewhat already. The US equity market is a little bit more expensive compared to many of its global peers. Valuation alone is not a reliable indicator of short-term market performance, but the US has been valued highly for a long time, and that needs to be taken into account. And it's worth noting that we don't, as I said, foresee a US recession as our base case, which would in turn lead us to obviously consider that US equity exposure. So we've reduced our US equity exposure somewhat. We continue to maintain that slight overweight position in US equities. That really reflects our confidence in the market's long-term prospects. We continue to actively monitor that situation. If we believe, reducing our US equity exposure is in our investors' interests, we certainly won't rule out reducing that exposure in the coming weeks if we perceive the situation to be deteriorating, or in fact, if we get a very strong rebound in the US equity markets on a reversal of tariffs, for example.
Thanks, James. And how about the US dollar?
So from a US dollar perspective, also an interesting perspective. So, we manage our currency exposure in our portfolios using both hedged and non-hedged versions of various ETFs when the underlying assets are denominated in foreign currencies. Currency hedging just refers to the management of currency exposure or currency risk. So if you own a foreign asset and it's denominated in a different currency, hedging allows you to manage or minimize that currency risk. For all our fixed income or bond investments, we primarily hold UK assets anyway, which are not impacted, of course, by those currency fluctuations. But where we do invest in foreign fixed income, such as high yield or emerging market debt, we hedge that exposure back to pounds to mitigate the currency risk. In our equity allocation, we hedge approximately 30% of our foreign equity exposure, although that percentage will clearly vary based on our market outlook. Recently, in response to the tariff announcement, we adjusted that exposure to US dollars. We brought it back down to a neutral position. And that decision really just reflects our tactical approach to managing currency risks, with the US dollar potentially less attractive than it has been recently. Again, though, with a long-term perspective, the US dollar tends to be an asset that in times of crisis, global investors seek. It tends to be a safe haven type asset that in the worst of times, investors have confidence in its value. So we do want to measure the current environment and the short-term headwinds with also the long-term perspective about how we build really robust, really diversified investment portfolios that are fit to achieve the long-term goals of our clients. Claire, I have a question here that's come through that says, have I lost money and what has happened to my invested capital? Maybe that's one you could pick up.
I can take that one. Okay, thanks. So for new investors in particular, then market falls can be worrying. And if you invested money at the start of the year, whether it's with Nutmeg or another investment manager, there's a greater chance that you may have seen the value of your investments decline. But it's worth remembering that capital value is not the same as cash. So capital value refers to the price levels that investors are currently willing to buy and sell assets like equities or bonds. So if the capital value falls, it's not the same as losing cash. So many things can impact financial markets that even if investments do as they're expected to do and increase in value over time, it's never expected to be in a perfectly straight line. There will be ups and downs along the way. So what's important to remember is that if investments fall in value, investors will only have lost money if the investments are sold at a lower level than when they were bought. And if you remain investors, then your investments have the chance to recover in value and potentially go on to grow. neither losses or gains are certain until we sell, withdraw, and confirm them. I mean, it goes without saying that nobody likes to see the value of their portfolio going down. And I know, James, as professional investors, this is a feeling that you and the investment team are very familiar with. And in all the market conditions, it's their job really to guide your portfolio through these environments. So you can rest assured that we're working hard to make sure that your portfolio is positioned appropriately.
Great, and I think we have a couple of questions on a sort of similar theme actually. So I'll group these into themes because there's a couple of very similar questions. But a great one from Helen. What's your general advice on when in the year to invest in stocks and shares ISA? Normally, I'd aim to put the maximum amount in early in April, but I've been a bit slower this year. And I think that also feeds with a theme around like what actions should investors take, and then also should they be changing the risk level of my portfolio?
Sure.
Claire, do you want to start, and I can fill in anything else?
Yeah, no problem. So on like what actions can you take? Should I change the risk level of my portfolio? Then I think, again, rather than focusing on what's happened recently in markets, your risk level is set based on your individual circumstances. So your investment time horizon, your capacity to take on risk and risk tolerance. So whilst it is worrying to see that value fall, just remember, if you're not planning on using the funds in the short term, then it is often best to stick to your original plan, because changing risk levels based on market movements involves what we've just been talking about, selling or buying, and effectively trying to time the market, which is notoriously difficult. And we've seen historically that those investors who stick to an appropriate risk level based on their goals and individual circumstances have had greater success than those trying to time the market.
Yeah, and I can pick up on the timing of contributions piece. So I think Claire's covered the sort of concept that unless something material has really changed in your circumstances, changing risk level, changing contributions, et cetera, is not always the wisest move, particularly for those long-term goals. With reference to your question, Helen, about exactly when to invest an ISA allowance, it's a really tricky one for me to answer. I don't have a crystal ball in terms of how the market will behave. We do have a number of blogs on the insight section of our website that look at, historically what has been the benefit of investing in a lump sum versus the benefit of time cost averaging over a period, so making those payments over a period. All of that is accessible on the insight section of our website. But if you can't find it, please do reach out to our client services team, and we'll be happy to provide you with that analysis. We do actually offer at Nutmeg a feature called Drip Feed, where you can pay the cash into the Nutmeg platform and then choose to set up an automated payment into your portfolio over time. And you can obviously tailor that and change that if your preferences change. But again, it's often just recognizing, what's your personal preference in terms of the way that you want to think about investing your capital. Obviously, if you invest on one particular time, you are beholden to somewhat to that entry point, whether it's good or bad. But also at the same time, if you space your payments out, you lose the effect of some of that compounding of returns through time, assuming that you believe financial markets are going to deliver returns. We have another question here around impact on personal financial goals and in particular interest rates and mortgages, and then also a similar question: what does this mean for my pension pot? Why don't I start here, and then I'll hand over to Claire for the pensions piece. So in terms of interest rates are influenced by a real variety of factors. So far, there has been no immediate change in the Bank of England base rate here in the UK, or in fact in the Federal Reserve over in the US. Our expectations are, as I said, for higher inflation in the US as a result of both tariffs and the fall in the US dollar, which would ordinarily make it potentially harder for the Federal Reserve to cut interest rates. But much really depends here on the path for economic growth, and specifically our watch point is the US labor market, the US job market, which, as we said, still remains relatively strong. We expect the financial markets expect the Federal Reserve to deliver 3 cuts to interest rates by the end of 2025, according to Bloomberg. And in the UK, we don't see that same inflation impact. As I said, we think US tariffs may even have the potential to lower some prices, particularly for goods, where lower US demand means that higher, those higher prices just can't be sustained. There might be an oversupply of goods and therefore cheaper prices elsewhere. Investors, for what it's worth, in the UK actually expect the Bank of England to cut interest rates 4 times by the end of the year, so reducing the current bank rate by 1%. All things considered, I think lower interest rates would mean lower mortgage rates in both markets.
Thanks, James. For those approaching retirement, and like you say, we've had a couple of questions on this. Some people, talking about going to start drawing from their pension in 2027. Like, when should they lower their risk level? And I think, seeing the capital value of your investments fall when you're getting closer to your goal can be concerning. But it's worth bearing in mind that even in retirement, many people will still have a significant amount of time to remain invested and won't be withdrawing all of their money at once. So there could still be time for investments to recover. And it can be a really good time to get some guidance or advice and potentially undertake something called cash flow modeling, where you can model out different scenarios and look at the impact of changing risk levels, and also understand how other, maybe more stable sources of income, such as state pension, any final salary schemes, or cash savings, can be combined with invested assets to try and deliver the lifestyle you want in retirement. So one option could be to think about using guaranteed or lower risk sources of income to meet essential and shorter term expenditure, but then remain invested or retain a higher risk level for longer term goals or more discretionary spending. So that's where getting some advice or guidance can really help work out what the best approach is for you individually. We've had another question that probably be good for you to pick up, James, is what is your economic outlook, and will the US slip into recession?
Yep. So again, we covered part of this, but I think at the current time, we don't expect a recession in the US economy in 2025 as our base case. As I said, we plan scenarios, so we look at the relative probabilities of certain outcomes taking place, and that's how we think about positioning our portfolio. So we don't expect a recession in the US in 2025 as a base case, and we expect earnings growth to remain relatively strong for US companies, albeit weaker than expectations at the turn of the year, given all the factors that we've been discussing. So we've already seen some of the tariffs that have been proposed either paused or rode back on, which should soften the effects somewhat of that policy. And in fact, we saw the IMF has come out recently and downgraded its expectations too for US GDP growth as a whole. But really critically, those expectations remain positive for US economic growth in 2025. So as I mentioned earlier, there's absolutely no doubt that the tariff announcements are a headwind for economic growth and also for confidence of consumers when it comes to their spending, their decision making around big purchases, and also confidence of businesses when it comes to hiring, investing in new facilities or expansion, whatever it may be. But our current expectation is not for a US recession. In terms of global growth, we think the impact of US tariffs is not going to be felt equally. The complexity of those supply chains, as we said, makes it very difficult to understand each country's level of dependency on US imports, and particularly then married with their negotiating approach or what they might be able to achieve in the coming months. But really, the all things considered picture there is that the outlook for global growth and for global trade is certainly lower than where it was at the beginning of the year. But we don't think we see that same inflationary impact we see in the US elsewhere. So All in all, recession risks have certainly risen since the start of the year, but we don't expect one in our base case, given the evidence that we have available today.
Thanks. And then linked to that, how long do we foresee this lasting for, and what do we think the long-term economic impact will be?
Well, I think the honest answer is we don't know. I think our best guess is that we can expect. I should say we don't know how long it will last. I think our best guess is we can expect to see markets remain somewhat volatile as the news cycle in relation to U.S. trade policy ebbs and flows. I was actually reminded by a colleague the morning that President Trump announced the 90-day delay to the extended tariff regime, that this could all be ended in one tweet was what they said. And I thought it was pretty apt, because while I'm not sure it's always as simple as that, the reality is that it's the US administration that has made this trade agenda central to their policy goals in the coming 12 months. And we expect the broad-based nature of the tariffs proposed means that a negotiated resolution is harder to achieve. Negotiating with one country on a trade deal is hard, but with almost every trading partner at the same time is clearly significantly more complex. But we should also remember, what drives the type of market volatility we've experienced of late is uncertainty. And after that initial shock and that rise in volatility, historically, as we said, what we tended to see is that volatility recedes. And that makes sense in many ways. Investors then digest the policy landscape. They're less surprised by evolutions, even if there remain unknowns on how that policy is going to play out. Claire, I'm gonna pick on you for another question, and I think we probably have time for one more question. So this question is: to protect myself, should I consider selling and holding cash?
Yeah, thanks, James. This is something we've been talking to quite a few of our clients about. And when it comes to the question of cash, we think it is important to have immediate access to some cash as part of your overall financial portfolio. So we'd usually suggest an emergency fund that could cover 3 to 6 months worth of essential expenses, and also enough to fund any short-term goals. So if your goals are within the next 3 to 5 years, then it's worth considering cash. But when it comes to investing for longer-term goals, holding cash is not really your friend, as inflation can erode its purchasing power over the medium and long term. As an example, the average floating rate on a cash ISA was just under 2% as at the end of March this year. But UK consumer price inflation is currently running at 2.6%. So the main takeaway on this point really is, if you don't need the cash now, then staying in the market can be the best decision, given what history tells us typically happens after periods of sharp market volatility. And as we mentioned earlier, it can be really difficult to make that decision as to when to get back in and make sure that you don't miss the upside as well as avoiding the downside. And as we've mentioned earlier, nothing is completely guaranteed on that. So we've probably got time for one more question. James, maybe one for you on: would Nutmeg consider offering a commodity-heavy investment style with exposure to gold?
Yeah, so we believe in offering, as I've said, offering our clients a globally diversified portfolio for many of the reasons that we've already discussed today. I think we don't reinvent the wheel when it comes to investment philosophy. At Nutmeg, we focus on what we believe are the core drivers of long-term investment success. Those characteristics and decisions we believe are the most important and the most impactful to your investing experience. Diversification, as an example, is one of those core characteristics, and really is as simple as the principle of not putting all of your eggs in one basket, spreading risk across a broad range of assets, regions, sectors, companies. And diversification is powerful because it can actually improve returns and reduce risk at the same time. There's been a lot of study that's been devoted to that topic since the birth of what was called modern portfolio theory in 1952. Its architect was actually a Nobel Prize winner, Harry Markowitz, and he argued that investors should view risk in the context of their overall investment portfolio rather than just simply its individual component parts. That might sound common sense to us today, but at the time, that was a huge step forward for an industry that had really just focused on picking individual winners with little concern for the overall mix. But diversification is really important because it's often ignored by many individual investors and actually in some cases professional investors too. So we think diversification is something you should really actively seek in investment portfolios, and frankly the pitfalls of doing so are very clear. Stories of fund managers performance deteriorating rapidly, for example, can often be traced to diversification issues. So it's unlikely we'd build a commodities only investment portfolio simply because we believe in that diversification. Commodities can still form part of our portfolios at Nutmeg. There are many commodity ETFs that we can utilize in our strategies to add commodities where we feel fit. When it comes to gold is an asset class that presents, I think, probably quite unique challenges in terms of valuation and allocation. It's done very well over the past 12 months, but still the volatility and performance of gold remain relatively complex. And it's important to note gold is valued at $2,000 per ounce in March 2024, the same level it reached in August 2020, indicating at that point nearly 4 years without significant performance gains. Recently, we've conducted quite a thorough review as gold as an asset, given the heightened interest in it. At its current level, following the really substantial increase, we perceive some real downside risk for investors in the short term, so we're a little bit cautious there. However, we also recognize the long-term global interest in gold and are open to the possibility of incorporating that in our portfolios if that risk-reward profile becomes a bit more attractive.
Thanks, James. Okay, well, hopefully everyone's found that useful today, and thank you everyone for joining. We did get some questions that were very specific about individual circumstances, which it's difficult to give a broad answer to on a session like this. So if you have got a specific question and we haven't covered it today, then please do use the QR code, book an appointment, and we can go into detail about individual circumstances. We also offer paid financial advice for those looking for a tailored financial plan to follow, and we can talk you through if this could be right for you with a no obligation consultation. We'll be keeping note of all the questions asked, and we'll look to address any that haven't been covered today in our next investor update and other communications in the coming weeks. Thanks, everyone.